Okay, hi guys. So what we're gonna do today is we're gonna try to introduce how you can use Excel to estimate beta. So there are by far you should have been through downloading data from Yahoo Finance and using a numerical solution method in Excel to find the optimal portfolio. So today, what we're going to do is we're going to use something called a regression analysis and the CAPM model to uh, to to estimate the beta of a stock. So you can use any stocks you want to conduct this practice, but that should be after this reading. So here we introduce CAPM. So CAPM basically says a stock's return is determined by beta and the market risk premium, right? And the market risk premium. So what we need to do is that what we want to do to estimate beta is that we want to find stock returns, the risk-free rate, and market risk premium in the history, and use the history data to estimate the historical, of course, beta of a company. Okay, so what we will do is we want to say, okay, suppose that CAPM is true, then the relationship between return and the market's return should be like this, be like what CAPM states. That is, it is beta times the market excess return, right? Or market risk premium. So, so the so if we can get data of risk-free rate and the stock return and the market return, we can say, okay, so what's the relationship between market return and stock returns in the historical data? What if we restrict the relationship to a linear model like CAPM? Then we want to find what does the historical data say about the coefficient which is in place of beta. So, so that's what we will try to do. We will need to first collect data on a individual stock return. I'm going to use Apple. And then we need to collect data of the stock market return. And of course, we need to collect risk-free rate. Uh, I'm also gonna show you how you can take risk-free rate. Okay. You all know how to download stock return data, right, from Yahoo Finance. So I'm just gonna really quickly download Apple stocks return data. Okay, so I have got the Apple stock price data, and then I need the market stock price data. So what do I mean by the market? So if you look at the readings, the market RM, market risk premium, is considered as the excess return you can get for bearing the risk of a so-called market portfolio. So the market portfolio is the composition of every risky asset you can find. So unfortunately, in reality, we do not have such data because there's no way you estimate, real estate, every piece of real estate in the world, right? So what we have to do is we have to find proxies. So what we're going to do is we will use the stock price or the indice price of S&P 500 index. Okay, so to download S&P 500 index on Yahoo Finance, you have to enter this sign and then GSPC. PC. It usually leads to S&P 500. But the issue is, I don't know since when Yahoo Finance is not allowing us to download any data from for the index. So we cannot really do it. So what we have to do is to find another proxy for this. But ideally, you want to use this if you can. But if you cannot, we're going to use something called a spider, SPY. So spider is a ETF, exchange traded funds, which tracks the return of S&P 500. So it tracks the return on a daily base, which means from day to day the returns are very similar. So from month to month the returns should be close enough. So what we're gonna do is we're just gonna download this data. All right, so this is the spider data, spider price data. So we can calculate the returns of the spider and the apple. So let me name this sheet estimate beta. So date, of course, in with date uh, and returns, right? Returns AAPL. Sorry. Oh, for some reason, AAPL, SPY. Okay. So the date will be the same as I'll use the SPY date. All right, so until January 2023, and the return, it equals to the same way you calculate the returns before. Adjusted close divided by the previous adjusted close minus 1. And then the same thing for the SPY. Okay, same thing for the SPY. So we got the data, the returns. Okay, so the next thing we need is actually the risk-free rate. Okay, Merchant Center, RF, we need the risk-free rate. So we need the risk-free rate so that we can calculate market risk premium, right? And the excess return of an apple. So let's excess returns, apple, and market risk premium. Okay. So for apple, it's going to be apple minus the risk-free rate. Okay. For the market risk premium, it's going to be spider minus the risk-free rate. As you can see now, they're like the same, right? If I copy down, they're going to be the same numbers. But the how do we actually get the risk-free rate? So there are multiple ways. One way you can do is first of all, what is considered as a risk-free asset? What is considered as a risk-free asset? We usually consider the US Treasury securities as risk-free. So where can we get the Treasury returns, right? So how much money you're going to earn if you invest in Treasury from month to month, right? So that is what we want to do. Okay, so good news is you can find a 10-year Treasury notes yield, which is the return that's you are expected to earn in a Treasury note on Yahoo Finance. So I just need to search for Treasury. As you can see, I have the TNX Treasury yield 10 years. So this is a medium-term Treasury yield, which is considered as a pretty good proxy for medium-term risk-free rate. So as you can see now, it's 3.522. That's 3.522%. Okay, 3.522% per year. Okay, so that's the data. So we need 5 years of data. We need monthly data. We need to apply. As you can see, the adjusted close and close, they're basically the same thing. So all we need to do is to download this return, convert it to a monthly frequency, and then use it in our calculation. So I'm gonna do the same thing. All right, so I'll call it just RF, risk-free rate. And then I just need to change all these returns into monthly returns. So this is 2.868%, right? So what I want to do is I want to say, okay, so the risk-free rate in March is 2.741, but it is a annual return and it is quoted in percentage. So I first want to divide it by 100 so that it's a numerical number. And then I want to go from an annual return to a periodical return, to a monthly return. So what can you do? You can do divided by 12, right? So you can just divide it by 12. So we got it. And then what I can do is I can just copy and paste. Everything is divided by 12. Okay. Okay, and then I copy this. Okay, so I got the relationship between, oh, sorry. Let's just copy everything here so that the formats are better. Sorry, we got the excess returns and we got the raw returns. So what I want to do is now actually begin estimating beta. So estimating beta requires us to estimate a regression model. So the regression model is like this. Here, just CAPM. So we want to say Ri minus Rf, which is the accessory term in Apple, is a function of Rm minus Rf. We're going to explicitly say that is the function. We're going to say, okay, so the relationship between Ri and Rf minus Rf and Rm minus Rf is just a linear function. It's just, it comes with a constant, which is 0, and it comes with a slope, which is beta. But we're not going to restrict how high the content will be or how high the beta should be. We're going to let the data to tell us. Okay, so that's what we're going to do. So how do we estimate a regression model in Excel? All right, so you go to data analysis, regressions. You just need to look for it. It's here. Okay. Input Y range is going to be the accessory term of Apple. Input X range is going to be the market risk premium. And then you want to output, let's just output it here. Let's say here. And then you don't really want to see all these because it's going to be really messy. So I hit OK. As you can see, I got the regression results. So I will not dive into the details of interpreting all these numbers because this is not a statistics class. But what I want to say is this is the estimated beta 1.2549. Okay, so if you're looking for the beta of the stocks, you can find it here. So how can we use this? So basically, this is saying that Apple has a beta of 1.2549, right? So in the next year, if the market risk premium is going to be, let's say, 10%, then Apple should earn 12.549% expectedly. So that is on average. So you do not really, it's very unlikely you get exactly 12.549%, but it's going to be a number. There's going to be a pretty big chance that it's going to land on that number if CAPM was correct. Okay, so that's it about estimating beta. I hope everything is clear. Let me know if you have any questions.